Welcome to the PAI Morning Briefing. I'm your host from Pantheon AI, and today is March 5th, 2025. Good morning, everyone. I'm excited to jump into today's conversation, getting into the nuts and bolts of what's been driving the markets, dissecting some of the most talked about stories, and of course, sprinkling in a little humor along the way, because let's be honest, a chuckle can go a long way when you're navigating these turbulent financial waters.
Let's start with a quick market overview to set the scene. The S&P 500 is trading at roughly 5,786.38, reflecting a slight uptick of approximately 0.086%. Not too flashy this morning, but it suggests that investors are treading water cautiously. Turning to the Dow Jones, it's sitting at about 42,683.77, with a more noticeable gain of nearly 0.389%. On the tech front, the Nasdaq is at approximately 18,294.43, down slightly by about 0.101%, a subtle reminder that the technology segment sometimes faces its own unique challenges.
At the crypto frontier, Bitcoin is trading around 88,942.203, having bounced up nicely with a gain of roughly 1.956%. Ethereum, not to be left behind, is priced at about 2,185.384, showing a modest improvement of around 0.676%. These digital assets continue to demonstrate their volatility and lure investors looking for quick swings and long-term potential alike.
Now let's dive a bit deeper into major market trends. Over the past few weeks, we've seen the traditional indices rally modestly while technology stocks face headwinds, perhaps a classic case of investors reevaluating their positions amid a mix of good economic reports and some geopolitical uncertainty. What's interesting is how the defensive sectors like finance and energy have held their own. Energy stocks, for instance, have been buoyed by higher crude prices amid ongoing global supply constraints, while financial institutions are benefiting from rate hikes and expectations of sustained economic recovery.
In recent sessions, one of the central themes appears to be a cautious optimism from investors balancing risk and reward. Markets are trying to reconcile robust corporate earnings with headwinds such as tariff uncertainties and softer-than-expected employment growth in some areas. Speaking of employment, let's sift through some of the important stories that have been circulating.
Our first major story revolves around German bond yields. Goldman Sachs recently noted that bond yields could climb another 100 basis points from current levels. This comes on the heels of Germany unveiling proposals to lift the debt brake and authorize major infrastructure and military spending. The euro has been on a strong run, and bond yields are reflecting that optimism, up by 25 basis points to around 2.73%. Goldman Sachs suggests that yields might jump to approximately 3.75% in the medium term if the proposals gain traction. This has important implications across Europe, particularly for investors holding European government bonds. It raises a thought-provoking question. How will central banks adapt to these rising yields, and what sectors might see best-in-class performance as a result?
Next up, we have repeated coverage on ADP's report regarding private job creation. According to ADP, U.S. businesses created just 77,000 new jobs in February, a figure that seems to be a cautionary signal regarding the pace of economic growth. In an environment where job growth has historically been a bellwether for consumer spending, these numbers have led some analysts to ponder if we're starting to see an early slowdown. What interests me is the dual nature of the story. While the headline suggests softness in job creation, it also points toward businesses possibly pausing to assess the impact of President Trump's tariff plans. It's almost like watching a carefully orchestrated chess match between policy signals and market responses. Do business leaders hold off on ramping up hiring because they're assessing risk, or is this just a blip in an otherwise robust economic narrative? This is something I'd love to see more data on as the weeks roll by.
Shifting gears, Tesla has found itself in the spotlight for less than stellar performance in Germany. Reports indicate that Tesla's vehicle registrations in Germany tumbled by 76% in February. It's the second consecutive troubled month for the electric vehicle giant in Europe's largest economy. The downturn in German sales highlights the increasing competition in the EV market, as well as potential challenges in meeting local consumer expectations. It's as if Tesla has taken a wrong turn somewhere on the Autobahn, and now investors are wondering if this is a short-term setback or if it signals a longer-term issue with Tesla's strategy in Europe. When you're discussing market trends, particularly in the tech space, it's important to note that even well-established names can sometimes struggle with regional market dynamics. The intriguing piece here is whether Tesla's overall brand value and innovation-driven approach can overcome these hurdles.
After all, even a speeding car sometimes hits rough patches on the road.
Another set of stories has been stirring conversation around a titillating tech stock that analysts have been eyeing. In one narrative that has been repeated thrice now, the sentiment is clear. Despite having trimmed positions at higher levels earlier this year, some market watchers are now buying the dip. The stock in question has been under pressure after issuing light guidance, even though it recently posted a strong earnings report. This is a classic illustration of how even fundamentally robust companies can experience short-term volatility when guidance falls short of investor expectations. It reflects the often unpredictable nature of the tech sector, where enthusiasm about earnings can be dampened by cautious forward-looking statements. It makes for a perfect case study on how market sentiment can oscillate between optimism and caution in the blink of an eye.
And it raises a simple yet crucial question. How much weight should investors place on forward guidance compared to solid underlying performance? This is a debate that will surely continue in conference rooms and trading floors alike.
What ties these stories together is the larger narrative of caution intermingled with pockets of opportunity. Whether it's European bond yields heading north, mixed signals on U.S. job creation, or the razor-thin margins in tech stocks, one theme stands out. The market continues to dance to the rhythm of uncertainty. It's reminiscent of a high-stakes poker game where every participant is trying to read the other's hand while the dealer keeps switching the cards. And as always, while there are plenty of risks, the potential rewards make it a game worth playing.
Let's now move into our detailed sector analysis. Starting with the technology sector, the lifeblood of our modern economy, it's clear that our tech giants and emerging players alike are running a gauntlet of regulatory scrutiny, market sentiment shifts, and competitive pressures. The tech stock we mentioned earlier, whose dip is now being viewed as a buying opportunity, is a perfect example. Even with robust earnings, the slight stumble due to cautious guidance might actually signal a temporary overreaction. In many ways, it reminds me of that old saying about buying stocks on the dip. Sometimes the market gets ahead of itself, and every investor wonders if they're buying a bargain or inheriting a problem. I might even say the tech sector sometimes feels like a roller coaster at an amusement park. Thrilling highs are tempered by stomach-turning drops, but in the end, you always come back for one more ride.
In the energy space, the trend has been decidedly bullish lately, particularly because global demand is still on an upward trajectory despite some economic headwinds. With crude prices rebounding and supply constraints continuing to be a recurring theme, energy stocks represent a significant portion of the market's resilience. This suggests that while there might be seasonal fluctuations, long-term volatility in the energy sector might be mitigated by robust fundamentals. When you combine such resilience with the broader narrative of infrastructural spend like what we're seeing with the German bond yields and their impact on European infrastructure portfolios, it gives credence to the idea that strategic investments in energy could yield solid returns for patient investors.
The financial sector, too, is having its moment of reflection. As central banks around the globe navigate the choppy waters of rising interest rates and tightening monetary policies, banks and financial institutions are uniquely positioned to benefit from a widening of margins. The recent uptick in bond yields, particularly in Europe, may have some short-term disruptive elements, yet it also signals a robust demand for fixed income returns. For those of you in this segment, it might be the perfect time to re-examine your portfolios and consider how rising rates could bolster profits over the coming quarters.
And speaking of global impact, let's pivot to the implications these trends have on markets beyond our shores. The interplay between domestic policy and global economic phenomena has never been more pronounced. For instance, Germany's fiscal maneuvers lifting the debt brake and endorsing heavy spending are not just about local fiscal policy, they're sending ripples across global bond markets. Investors around the world are keenly watching how Europe's largest economy navigates these waters. Meanwhile, in the United States, job creation figures like the modest 77,000 private jobs reported by ADP hint at a double-edged sword. On one hand, caution among businesses. On the other, a potential recalibration of growth strategies in light of tariffs and trade tensions.
On the international stage, the relationship between traditional markets and emerging assets like Bitcoin and Ethereum continues to evolve. The respectable performance from Bitcoin, with gains of nearly 2% and a modest yet positive move in Ethereum, illustrate that even as traditional sectors face headwinds, investors are diversifying their portfolios. It's an interesting dynamic. While some sectors are stepping on the brakes, others, particularly in digital finance, are rapidly accelerating. I find it rather fascinating how interconnected everything is nowadays. A policy decision in one country can set off chain reactions that may influence investment flows thousands of miles away.
Now let's bring in some expert insights and predictions. In conversations with several colleagues and market watchers, there is a growing consensus that markets are in a phase of cautious rebalancing. While the fundamentals remain strong in most sectors, the uncertainty bred by policy shifts and global economic headwinds makes it prudent for investors to stay nimble. One expert confidently stated, "It's like trying to navigate a maze with blindfolds on," highlighting the unpredictability of current market conditions. Another quipped, "If it feels like the market's on a seesaw, just remember, sometimes a little wobble is all it takes to get a great view." And truly, this underlines the importance of having robust insights and a measured approach, not unlike our trusted Pantheon AI, which serves as your information co-pilot.
For those of you invested in technology, the key takeaway might be to watch for opportunities in these dips. When a tech stock that's repeatedly traded at higher levels suddenly shows up for a discount, it's a moment that requires both nerves of steel and a long-term vision. Conversely, in sectors like energy and finance, the current environment seems supportive, suggesting that a diversified strategy could be very effective in weathering the ongoing volatility.
I'd like to share a bit of humor here, something every investor can relate to. I once heard a joke that said, "Investing is like trying to predict the weather. Sometimes you bring an umbrella, and other times you wish you'd brought sunscreen." It's a cheeky reminder that in the world of markets, we're always playing a guessing game. Even with the most sophisticated models and expert opinions, the future remains inherently unpredictable. And that, my friends, is what makes the journey both exhilarating and, at times, downright frustrating.
But let's not forget the human element in all of this. Behind every stock tech and every market move are decisions made by people, driven by hope, fear, and the pursuit of excellence. It reminds us that while we use metrics, percentages, and data points, investors and traders are fundamentally decision makers. Each headline, from German bond yields to Tesla's struggles in Germany, is a reminder of the tangible impact policy decisions and corporate strategies have on people's lives, communities, and even national economies.
Let's take a step back and consider the broader picture. What does all of this mean for your everyday investment strategy? It might be the perfect time to ask yourself, have you re-examined your asset mix lately? Are you adequately diversified to weather a storm on one side of the market while capturing growth on the other? For instance, if technology appears to be at a temporary standstill, perhaps there's an opportunity in the energy or finance sectors that's being overlooked by the mainstream. And with Europe's bond yields potentially shifting significantly in the medium term, what might that mean for fixed income portfolios? These are questions that every strategic investor should be pondering as they plan for the future.
Turning our attention to global market implications, there's also been chatter about how rising yields and cautious job growth might influence emerging markets. Many of these economies are deeply entwined with the performance of developed markets. A rise in European yields, for example, could lead to capital outflows from emerging markets as investors chase the relative safety of higher, more stable returns. But there's a flip side to that coin, as well. Emerging markets could benefit from lower borrowing costs if global conditions shift. Think of it as a delicate balancing act. Every action sends ripples throughout the global economy, reminding us once again of the interconnectedness of our world.
Looking ahead, my prediction would be that investors should brace for a period of gradual adjustment rather than abrupt, sweeping changes. The fundamentals remain robust, but the market's reaction to policy shifts and earnings reports will likely be characterized by moments of volatility interspersed with periods of calm reflection. It's like navigating a river that sometimes has turbulent rapids and at other times flows smoothly. Patience and a steady hand remain the best navigational tools.
In summary, what are our key takeaways for today's episode? First, we're witnessing a blend of cautious optimism in the major indices, with modest gains at the top and slight declines in specific segments like the Nasdaq. Second, the crypto market, especially Bitcoin and Ethereum, continues to show that digital assets are increasingly a part of the mainstream investment dialogue. Third, multiple economic stories from Europe to the United States highlight the delicate balance between policy decisions, job creation figures, and corporate earnings, each telling its own part of the story. And finally, whether it's a tech stock that's underperforming its guidance, Tesla's sales troubles in Germany, or a potential surge in European bond yields, the underlying lesson is that today's market is as dynamic as ever.
Before we wrap up, let me leave you with a few thought-provoking questions. How will the anticipated rise in German bond yields influence your fixed income strategies? Are you prepared to recalibrate your portfolio in light of modest U.S. job growth, or are you comfortable riding the current wave of cautious optimism? And with technology stocks presenting both risk and opportunity, what signals are you prioritizing in your next investment move? I always enjoy hearing your perspectives, so don't hesitate to reach out and ask questions to our AI co-pilot here at Pantheon AI.
In closing, I want to thank you for joining me on this morning's briefing. It's always great to dive deep into the numbers, narratives, and nuances that drive our financial world. Remember, Pantheon AI is here to serve as your information co-pilot, steering you through even the most intricate market landscapes. Stay tuned, come back for the next episode tomorrow, and keep challenging your assumptions. The market is a constant teacher. After all, as I like to remind everyone, learning shouldn't feel like a full-time job.
Until next time, keep your capital safe, remain curious, and happy investing.